Hello, everybody. Welcome to Talk About House. I'm Todd.
I'm Juana.
Okay, so we're going to do an update here about the historic relationship between interest rates and home prices and all that. We got a lot of heat for merely showing how over the last 4 weeks home prices have gone up in Vegas. And it's not really going up. It's fake, or it's just, you can't count 4 straight weeks. That's not.
Okay, so how long can we count?
I don't know, but when the second they dropped, it was the housing crash. But now that they've gone up 4 straight weeks. Okay, this is what we're going to do. We're going to go, we have Fred charts.
Fred is our buddy.
Fred is not a guy named Fred. It's the Federal Reserve.
I thought it was Fred next door.
It's not Fred next door. It's Federal Reserve. And it's data that they've collected over many years. Okay, this is the first one we're going to do. This is the 30-year mortgage rate. Okay. This is the 30-year fixed mortgage rate. This is Freddie Mac 30-year. Now, don't confuse Fred and Freddie Mac. Fred is not short for Freddie Mac. Freddie Mac is mortgage lending. They're a government-owned entity, not really government-owned, but they're government chartered entity that sells that controls the sale of the secondary of mortgage loans on the secondary market.
Right. So, in English, when you get a mortgage and then your lender sells your mortgage on a secondary market, guess who buys it?
Yeah, they regulate that and do that to make sure that whole thing becomes stable, because they don't want the paper that backs your house to be.
They ensure mortgage liquidity so that people can get loans.
Right. Okay. So, Juana, when you look at this chart, now all of you can see the whole thing on your screen, but I want only people to look from the last time interest rates were where they are now, which was like 2003. Mm-hmm. Because before 2003, interest rates were higher than they are now. Are a lot of people getting upset that interest rates are much higher than they were 2 years ago?
So, yes. But, I think what we need to really look at is perspective. The people who are getting upset, and I'm not picking on any generation in particular, but the people who are getting upset are the people who simply were not in a home buying position for more than 20 years. So they have a very limited perspective as to what interest rates do over time. So yes, for the last 20 years, mortgage rates have been sub 7.5%. However, traditionally, mortgage rates have been, on average, between 7 and 7.5%. And of course, average is this really terrible word, because now we're taking in those 18% mortgage interest rates from 1980, 81, 82, and we've got the sub 2%, 3% ones from a year or two ago, and then we mush everything together over the last 40, 50 years, and this is where we are. I think people are getting upset because, like I said, they simply have not had this experience in their home buying lifetime. Not in their lifetime, but in their home buying lifetime.
Okay. Obviously, there was a point where 30-year rates were 18%. Mm-hmm. And what was interesting was home prices those years went up. They didn't crash.
No.
People kept buying houses, and there was no massive buildup in inventory, the normal number of home. People just dealt with it, right? People
dealt with it because, like I said before, people are adaptable. The other reason is that when interest rates are so high, they are generally commensurate with high inflation, not necessarily point for point, but they are commensurate with inflation. So a home, real property, is a good place to park some money and ride out the whole inflation thing.
Okay, I'm going to now memorize this chart, because what I'm going to do is I'm going to flip over really quick to the median sale price of houses in the United States. You can see there is not a 1-for-1 correlation. A lot of people have been alleging, but Todd, you don't understand. If mortgage rates go up, home prices have to go down. Look at this chart. Do you remember mortgage rates going up and down, especially spiking around 1980? Look what happened in the early 80s. Did you see a massive crash in home prices when mortgage rates went from 10% to 18%? No, they didn't. Home prices kept going up.
So part of the reason why the home prices kept going up was that people were still doing transactions, and part of the way that they were doing transactions is they had assumable loans. And we've talked about this before. When interest rates go up, there are assumable loans. Now, for those of you who say, well, okay, but only FHA and VA are assumable, not quite. A lot of conventional loans are assumable too. You have to check with your lender or your servicer and ask if your loan is assumable. Most loans, I would wager, are assumable.
Right. The next chart we're going to go to here is inventory. As you'll notice, inventory in January was 625,000. This is the end. It was this nationally. This was the end of January. In March, we'll have the end of February numbers. You can see the historic trend of homes on the market. If you look back to 2017, 18, 19, those time frames, we had over 1 million. Mm-hmm. Now we have 625,000. That number is rapidly declining. Mm-hmm. We saw the same thing in Vegas, where the number of homes on the market in Vegas have collapsed 40%. Mm-hmm. These homes are not on the market.
So we're talking about inventory being very low. We're not talking about home prices collapsing. So make sure that you understand that.
This is the active listings in the whole United States. The whole United States is how many listings. Now, if you look all the way to the right there, the peak of that down, those were all happening during these 7.5% interest rates. Okay? Matter of fact, all of that down when all interest rates are above 6%. So Juana, how do you answer somebody who says, but Todd, the interest rates nobody will want to buy and the number of listings will pile up and it'll crash home prices? It's going to happen. It'll happen next week. Because they went up in a week. You just wait. And now all we're seeing is inventory disappeared. Is this number going to instantly, like if you look back over this chart, they go up, they go down, they go up, they go down. But if you look at the trend over the long period, the amount of inventory is just being decimated every year.
Right. So first of all, historically, we've just shown you all the lovely charts. Historically, that doesn't bear fruit, right? Interest rates going up does not bear fruit regarding inventory levels rising. Second of all, like I said before, there are people with sub 3% interest rates. So if they want to sell, those loans, most of them are assumable. So people would be more than happy to take over those loans. Lenders are doing second trust deeds to meet that difference between the first trust deed and the equity of the home seller. So that's certainly an option. And then, of course, remember there are lots of people who are purchasing cash. And the whole thing with the interest rates, it's just it's a red herring, to be honest with you, because interest rates don't keep anybody from purchasing. They keep people from purchasing maybe the home that they would want, but not from purchasing anything. So, for example, I might want a home that's $32 million. Well, I don't care if the interest rate is zero. No matter how much I want that house, and no matter the interest rate being zero, I can't service the debt on a $32 million house. Yeah. Okay? So it's the same thing with everybody else. What debt can you service? And yes, it definitely impacts the amount of debt that you can service, but that doesn't mean that you can't buy. It's just that you have to buy something else. Okay.
Now, what about this, though? There's this FOMO, fear of missing out. Mm-hmm. Okay, imagine this. Your whole case, your belief system is based on, well, the only way you can buy a house is you have to get a mortgage for the whole thing. Therefore, if interest rates go up, the affordability drops. It's the worst affordability ever. I don't understand, because I got $500 in my bank account and I'm going to go buy a loan with an FHA and get the seller to put in 3%. I'm going to take my $2,500 a month income. I can't buy any houses, so nobody else can buy a house. If I can't buy a house, nobody can buy a house.
Everybody's situation is unique. We've talked about this. And people who want to buy a house and have good credit, are disciplined, have 6 to 8 months of savings to weather whatever happens, maybe have money that they've saved away besides that for a down payment, or they've got a gift from somebody, or they can borrow against their retirement fund, or they can do a zero down VA, or whatever their story is. Look, people can buy a house. Okay, like I said, it may not be that $32 million house, but they can buy a house.
Okay, imagine this. You just watched a YouTube video about the real estate market. You're realizing home prices are starting to climb again. Okay? You're qualified to buy. You can go out and buy. You then see somebody comment on the video saying, But Todd, interest rates are only 6 3/4 now, but they'll be 7.5 or 8% in 2 months. So don't you naturally say, okay, wait, home prices are going up, interest rates are going up. I should buy now before prices go up even more, and I don't have to buy. I'll just lock in that low 6.75% rate because somebody just said they're going to be at 7.5 or 8% in a couple months. I'll lock in 6.75 now, and I'll get it at a lower price, and I'll get it in 3 months, right?
Right.
So are there people doing that right now? Because the inventory chart is pretty sobering to have the highest interest rates we've had in 20 years. Because the conventional wisdom is inventory should be piling up and then just desperate sellers should be crashing their prices to sell. Is not happening.
Right.
Is literally not happening.
Okay, so people have been doing that for probably the last 7 months or so, as far as maybe they've got a house that's being built, so new construction. They have locked in their interest rate. They paid a premium because it's a long-term lock, and long-term locks are expensive. They've paid a premium and they've locked in that rate. The issue with it is generally it's hard to lock in a rate if you haven't picked a property. But if you've picked a property and your close of escrow date is 30 days, 45 days, 60 days from now, a lot of people are choosing to lock in the rate now, thinking that that rates may go up. But it's whether rates go up or not is really not particularly material for most people, because most people hopefully are not riding it that close to the vest. And a lot of people are saying, hey, you know what, I'm going to kind of suck it up for the next year or two until interest rates come back down, and then I'm going to refinance. So whatever that interest rate is, not my favorite, but that's fine because I found my forever home, and it's worth it to me.
Okay, here's the last chart. Household owners' equity in real estate. It has absolutely skyrocketed.
It has, but we talked about this recently on a video, and it has for a number of reasons. One of them is the baby boomers. The baby boomers have had a lot of time at this point on this earth. They are the wealthiest as far as equity in their homes, and they are not moving. They are keeping their homes. And so there's a lot of equity tied up in these homes. The other reason is, and we've talked about this kind of ad nauseum, is that 40% of homes in the U.S. are free and clear. So again, that's a lot of equity, whether those are baby boomers or investors or whoever they are. So remember, lots of people purchased homes, 15 years ago, 10 years ago, 8 years ago, and they purchased them cash because they were buying them for 100, 150, and 200,000, and now those homes are worth maybe 500,000. So that's again a lot of equity. And then lastly, people have had low interest rates for a long time. Maybe they've doubled up on payments and they owe little to nothing on these homes. And again, that's a lot of home equity. So between all of these factors, it's a perfect storm for a lot of equity being locked up in homes between the baby boomers and everybody who got a great deal over the last 10, 15 years on real estate.
You bought a house, you bought a whole bunch of houses. You came to Vegas and we had two different investors buy 50 houses. And their criteria was almost exactly the same. $80,000 to $100,000 could get at least $1,000 a month in rent. $5 million to buy 50 houses each. You fast forward now, those houses are all worth $300,000 to $400,000. They were in the lower end of the house range, but they're all worth $300,000 to $400,000. If they sell them, they would have to pay capital gains taxes on all of them.
Well, they would, and then the question isn't just the capital gains tax or the transaction costs to sell these properties, but the question is also, what are you going to do with the money? I mean, if you have a better way of investing the money, that's great. But for the most part, I don't know that there is really a better place to put the money right now, particularly when you're calculating, to your point, the taxes and the transactional costs to sell these properties.
I have never, in my almost 40 years of being a homeowner, I bought my first home at 22. I know you bought yours at like
20.
Bought it on active duty when I was in the Marine Corps. I have never, ever, ever seen people hodling, like in crypto, hold on for dear life, their real estate. They're not getting rid of their real estate. We know a ton of investors. we've had, I think, one investor in the last 2 years sell a house, and it was, well, they were like retiring, right? They were like, they
Right.
just wanted the cash for the last, like, I mean, we know people that have had houses for 20 years that are just like, I'm never selling.
Right. Yeah, and that's a consideration at this point. I mean, I know people who own their homes and they own them free and clear, and their position is, hey, if I get my happy number, great. If I don't, that's okay. I'll wait until the market catches up with me.
Okay, so let's talk about 3 things. I want you to rank them.
Okay.
I'm gonna just give them to you in a random order. One is 6.5% to 7.5% interest rates, which are historically average to below average, right? Over the last 10 years, they're high, but historically, they're not completely horrible. Owner's equity, all these people who have all this cash tied up in real estate, or absolutely plummeting inventory. Which of those 3 is the main reason why home prices just aren't falling out of the sky right now?
Inventory.
Oh, inventory. So
Inventory is number 1.
you have buyers still buying, and they have less to pick from. It's getting more competitive. Anecdotally information, talking to people in Florida, multiple offers are back.
Right.
They're like, their homes are going on the market, multiple offers immediately.
We have multiple offers here.
We have multiple offers here.
Yeah.
Yeah.
So number 1 is inventory. Number 2 is
On
is-
million-dollar homes?
is equity. Yeah.
Okay.
Million plus. Yeah. So
That's one.
So
Inventory.
number 1 is inventory. Number 2 is equity, meaning people have equity in the property and they're just not in a position to take less than whatever it is that they want for the property. And
Okay.
and number 3 is
Or they don't want to pay the taxes.
They
or
don't
they don't
wanna
want
pay
to
taxes
give,
or whatever.
What about giving up the income? Because a lot of these people are getting pretty substantial income
Right.
from, and the income that they're getting is just going up every year.
right. Yeah, and I like mailbox money. I think a lot of us do.
Okay.
So
So last would be interest
and,
rates.
like I said, the interest rates are really a yawner as far as I'm concerned. They really are. People are so adaptable. People have already almost forgotten about the sub 3% interest rates. When interest rates hit, right around 6%, everybody got excited. Everybody thought this was fantastic.
I remember that, yeah.
So you would think that interest rates had gone down to 3% again. People are so excited.
Right.
So people are very adaptable, which is a good thing.
Right.
And, I don't know what's going to happen, 6 months down the road, but I can tell you that the spring is going to be good for real estate in the sense that buyers are interested in buying and sellers are going to do really well. And sellers are going to do well less so because of buyers and more so because of the lack of competition, the lack of inventory. That's going to be the primary thing that is going to sustain prices for the next few months. Now, if inventory starts to rise, again, that's a different story. But notice that in this, nowhere did I mention interest rates. That's really not part of the equation at this point.
Okay. I'm going to make a prediction for this year that I made last year around this time, early spring, that 100% came true. The 4 best months to buy a house, I predict, will be October, November, December, and January of 2023 and January 2024, just like they were this year.
So,
And why is that, Juana? Why will those be the 4 best months to run out and buy a house?
because they always are.
They always are. Why are they always the best months for a buyer?
Oh my goodness. So those are always the best months to buy a house because generally speaking, the buyers have already settled in for the school year. So not that everybody's got kids, but certainly people with kids make up a good portion of the market. So they're out of the buying market. And then the people that are left get to have a few more choices and a little less competition. And we're also heading into the holidays, so people are less likely to want to go house shopping. They're more likely to spend money on other things. We're also heading to the end of the year, so maybe people are anticipating maybe a tax refund in the spring, so they're waiting until that comes around.
Okay.
So people have lots of reasons why the fall is not their choice time to buy a house. But that means that for those of you that are in the market to buy a house in the fall, that's a good time for you to buy a house because you have less competition. Sellers are more interested in selling. Part of the reason why sellers are more interested in selling, particularly investors, is because maybe they want to take advantage of closing the transaction in this tax year. So that makes a big difference. You see that with builders a lot. They'll offer incentives in November if you can close by December 31st. Maybe they'll offer you a few spiffs because, again, they're trying to make their books look good.
A bunch of builders actually made a killing in 2022.
They did.
A bunch of them, though, did discount houses to sell them, to get them off their books, to reduce the amount of taxes they would pay in profits. And not because they didn't want to push that into the next year, because these are publicly traded companies.
Right. So this is really common. I think most years, not every year, but most years, you do see builders being more liberal with their incentives come end of October and all of November, so long as you can close in December. But that only is viable for their standing inventory. They're not as amenable for inventory that's not going to be able to close until the following year.
We keep hearing about the new home builders and how their unsold housing inventory will crash the market. KB Homes is the largest. They're the big monster out there. 13,000 homes nationwide is what they sold last year. And it's in line with the last few years. That's what they sell in a year. 13,000 homes across the entire United States. Inventory right now is 625,000. If all 13,000 houses got dumped on the market in a single, they didn't sell one house through their new channel. They just dumped them in the MLS.
Right.
With that 625 would just go up to 638.
Right. So
it wouldn't really change.
No, it wouldn't impress anybody.
It wouldn't impress anybody.
No.
And the truth is, every single new home, every single one that doesn't get sold by the builder gets put in the MLS. It's already counted. If you're talking about, well, but 400 homes are going to hit the Las Vegas market, they're counted. They're in the MLS. I can go in the MLS and pull them up and show them to you. So, people have, I don't think they understand how all this works. It's like the video with the old ladies, and she's saying, "Oh, this is my wall, and I write stuff on the wall," and she's alluding to Facebook,
right?
And she's like, "You don't understand how this works. That's not how this works." You can't dispute the data. We're not pushing an agenda. We're just talking about why the data is doing what it's doing. This is not good for us personally. We would rather see a ton of inventory with a ton of people selling, and especially a ton of people selling. We don't like the fact that a lot of people aren't selling. We know exactly what's going on here. This is why we're not ever selling any house that we've ever owned.
Okay, so the point is that real estate agents make money through transactions. So when there are less transactions, we make less money. So we are definitely pro a rise in inventory, so there can be more transactions.
Yeah.
So if we presented some information that interested you, that was novel to you, that offended you, that's fine. Go ahead and like the video, subscribe, hit the notification bell, share the video, leave us a love note, and be nice to each other in the comments. We'll see you on the next video. Bye.
Bye.